What's up you guys, Tomy Shaw here, and today's channel what I'll be doing is showing you how to make money like a bank, because I just want to get you thinking of how to use strategies to put interest rates in your favor. Okay, so let's look at two strategies that I use, okay, to use money like the bank. What I'm trying to do is I'm trying to reduce one interest rates to another one because I'm profiting the difference. This is almost zero risk because you're reducing the amount that you have to pay. Okay, so the first strategy that I use, let's say I owe $10,000 at 6% and I owe $10,000 at 3.5%. okay, and I have $10,000 accessible. What I'll do is I'll take that 10K accessible at 3.5% and pay off that 6%. So that saves me 10K at 2.5%, which is around $250 a year, or maybe $22 a month. Okay, it's free money, it's easy money. A lot of people will say pay the lowest interest or the highest amount first. I don't believe in that. What I look at is the interest. That's the only thing I care. When you're investing, you're looking at interest. When you're paying off debt, you should do the same. Okay, second, variable versus fixed rate mortgages. What I'll do is that I have some variable rates mortgages and I have some fixed mortgages. And why I'm doing that is that if I see the 10-year bond going up, I'll fix my mortgage, okay, to protect myself for the next 5 years. When I see the 10-year bond going down, I'll take a variable rate and I'll refinance that mortgage. Okay, let's say for example I have a 3% fixed mortgage, $300,000, and I have, just before interest rates start to drop, I take a 2.75% variable rate and the market dropped 1.5%. So what I'll do is that I'll refinance as much money as I can. I'll take it out and then I see my new mortgage go down to 1.25%. And what I do with the extra $50,000, if there's no deals out there, what I'll do, I'll take that $50,000 and put it on my $300,000 and try to reduce the impact of this 3%. Because if interest rates are dropping, that means that inflation rate is dropping. So the real rate that you're paying is higher. Because remember, at first, when it was 3%, that meant that inflation was around 2.5%. So that 3% was actually costing me 0.5%. But now, if inflation is a negative, this is costing me 3% plus the negative interest rates. So maybe 3.2%. And I'll try to reduce my weighted average cost of capital by taking a lower cost of capital and putting it on a higher cost of capital to try to reduce that. Because when I reduce my weighted average cost of capital, I did a lot of videos containing this information. That's why I'm going over it very quickly right now. What happens is that when you reduce the cost of capital, what happens is that you're able to take out as much value of your assets. So all your assets gain in value and you're able to refinance, get that money, and if a deal shows up, you're ready for it. If you have something on the market, then you can take that money and go on the market. But remember, I'll stick to this topic on this video, is how to use money like the bank. So essentially what you're doing is that you're using spreads. What the bank does is that it borrows from the central bank at maybe 0.25 or 0%, and then it loans it out to you at 3% or 1.75%, and they're using that spread to make money. What I'm showing you guys right here is the same thing, is the same method. I'm showing you guys how to take debt, which is not yours, and you put it on another debt to reduce the value of that debt, and what you're doing essentially is you're pocketing the difference between that spread. Okay, so that's that for this video. If you like this kind of information, like, subscribe, and I'll be seeing you on the next video. Thank you.